I have a very interesting meeting here. I'm in a Homewood Hotel Suites, Canada. Today I'm meeting here team Carroll, mortgage broker, and we're going to talk about mortgages and interest rate and all the banks ins and outs. So let's go and talk to him. Team, I want to ask you for another question that a lot of people asking me. A lot of people bought an investment properties, I would say quite a few years ago, and right now their term of 5 years is up and they have to take another mortgage. And does it make sense for them to leave those properties and take the interest on the mortgage and continue to have those properties, but to save a big drop in profits from the renters, because they cannot jump in the rental so much. They cannot ask people to pay $500-600 more a month. So they're thinking right away to sell the properties. And what I would suggest them as a real estate agent, not to do that, although it's against my kind of, I'm not going to get paid, but I would suggest not to sell the property. I would suggest to keep the property for as long as they can to get more out of it. So what do you think?
All right, so it definitely comes down to capitalization ratios. I can kid you not, because you need to find out about utilization and how far the actual house will go in terms of paying down the mortgage, as well as obviously increasing in equity and value. That's gonna be a really big, huge measurement tool as to what you actually wanna do. My first instinct, right way to tell you is to try to see if you can actually stretch out the amortization. You might be actually at 20-year amortization example right now, but what you need to do is you need to make sure you mimic the amount of money you're coming in versus the amount of money going out as close as possible. If not, obviously you're making a little more money, but what you want to do, try and mimic it. So if you can stretch your amortization from 20 years to 30 years, yes, the interest rate goes up, but it almost copies what you're paying today before that new interest rate. I recommend that as being my number one choice. My second option, obviously, and sometimes you might have to reach out to me because there'll be some advice I'll give it to you on a per case basis, but you want to take a look and see what options do you actually have for increasing rent? What options do you have for obviously doing maybe a mortgage where you're only paying interest? Obviously, sometimes those mortgages are only at 65% loan to value. You got to be very aware of those things. But number one, see if you can stretch out the amortization, bring the obviously the interest rate down. Two, I might even take a shortfall because right off the taxes for this one, but take a shortfall for maybe the first 6 months or 2 years to do that. And when you take a shortfall for those 6 months, 2 years, or 3 years, again, you're getting a higher interest rate, but you're going to be able to get out of it a lot quicker to be able to obviously change as well. I have a lot of clients who are actually coming to me with this as their basis points. Again, it really depends upon per case as to what you can actually do. I'll give you an example. One of the clients I actually right now, they decide to sell their property only because they had enough equity in it to be able to pull out and sell it at a top tier dollar. And then they took that money and they're gonna be nest egging it for the next purchase they're gonna do, whether that's gonna be in a certain amount of time, obviously.
We had an amazing meeting with Tim. We found out a lot of different nice, good, interesting information about interest rate and all the mortgage in and outs. And you know what? I hope that you found today and heard everything you needed to hear. If not, you can call me and I'm going to let you speak with Tim. I'm going to put you in contact with him. If you want to sell or buy the house, you know where to find me. I'll be in Usher, your Ottawa real estate expert.